Right now, the average 30-year fixed mortgage rate is sitting at 6.9%. But last month, a buyer in Dallas locked in an effective rate of 4.8% on the same loan product from the same lender on a house in the same zip code. The difference? One paragraph buried in their offer letter. It's called a 2-1 Buydown, and it's not a special program. It's not a government benefit. It's a negotiation tactic that redirects money the seller was already willing to spend and funnels it directly into lowering your rate. Over the life of the loan, that single paragraph saved this buyer over $47,000. And the wildest part? Their agent almost talked them out of it. Here's exactly how it works when it backfires, and the word-for-word script you can copy into your next offer. Let's strip away the jargon. A 2-1 Buydown is a temporary interest rate reduction paid for upfront, usually by the seller. In year 1, your rate drops 2% below the note rate. In year 2, it drops 1%. In year 3 and beyond, you pay the full rate. So if your note rate is 6.9%, you're paying 4.9 in year 1, 5.9 in year 2, and 6.9 from year 3 onward. The money that funds this reduction sits in an escrow account. Your lender pulls from it each month to cover the difference between what you're actually paying and what the full payment would be. You qualify at the full 6.9% rate. That's critical. This isn't some adjustable rate gimmick. Your loan documents say 6.9. You just don't pay it yet. Numbers make this real. Take a $400,000 loan at 6.9%. Your normal monthly payment, principal and interest, is $2,634. With the 2-1 Buydown, year 1 drops to $2,097. That's $537 back in your pocket every single month. Year 2, your payment is $2,362, still $272 less than the full amount. Add those savings up. Year 1 saves you $6,444. Year 2 saves you $3,264. Total first 2 years, $9,708 in reduced payments. Now here's the number that matters, the Buydown cost. For this loan, the seller funds approximately $8,200 into escrow. They're spending $8,200 to save you $9,700. That's an 18% return on the seller's concession. No price reduction gives you that kind of leverage. If you want to push the math further, the 3-2-1 Buydown exists, and in the right market, sellers will fund it. Same concept, one more year. Year 1, rate drops 3%. Year 2 drops 2. Year 3 drops 1. Year 4 onward, full rate. On that same $400,000 loan at 6.9, a 3-2-1 Buydown puts your year 1 rate at 3.9%. Your monthly payment, $1,884. That's $750 less per month than the standard payment. The total savings across 3 years climbs past $16,000. And this is important, the upfront cost jumps to roughly $13,500. That's a bigger ask from the seller. In a balanced or buyer's market, you can absolutely negotiate this. In a competitive market with multiple offers, stick with the 2-1. It's easier to get approved, and sellers are more likely to say yes. This is where most buyers get confused and where most agents give bad advice. You have 3 ways to use seller concessions: a Buydown, permanent discount points, or a straight price reduction. Let's compare all 3 on the same $400,000 purchase. Option 1, the 2-1 Buydown, costs $8,200, saves $9,700 in the first 2 years, immediate cash flow relief. Option 2, buying down the rate with permanent discount points. $8,000, roughly 2 points, buys your rate down from 6.9 to about 6.4 permanently. That saves you $125 per month. Sounds great, but it takes 64 months to break even. That's over 5 years. If you refinance before then, and statistically most people do, you've lost money. Option 3, an $8,000 price reduction. This drops your loan amount, saving you about $42 per month. $42. The Buydown wins in the short term by a landslide. Discount points win only if you stay in the loan for over 5 years. And the price reduction is, frankly, the worst use of a seller concession dollar for dollar. Here's the psychology most buyers miss. Sellers don't care how you use their concession, they care about net proceeds. If a home is listed at $425 and you offer $420 with a request for $5,000 in closing cost credits, the seller nets $415 either way. But if you offer full asking price, $425, and request $8,000 toward a Buydown, the seller nets $417. That's $2,000 more than the price reduction scenario. You're literally giving the seller more money while getting a better deal for yourself. This is not charity. This is structural arbitrage. The seller's concession costs them less than a price cut would, and it delivers more value to you than any other use of that same dollar amount. When you frame it this way in your offer, And I'll give you the exact script in a moment. Sellers say yes far more often than you'd expect. Copy this language. Seriously, screenshot this or check the description. In the additional terms section of your purchase agreement, your agent writes, seller to contribute $8,200 toward a temporary 2-1 interest rate Buydown on buyer's behalf to be held in escrow by the lender. This concession is included in the purchase price and does not reduce the contract price. That last sentence is the key. You're telling the seller your net doesn't change. I'm not asking for a discount. I'm asking you to redirect funds that make the deal work for both of us. Now, some lenders cap seller concessions at 3 to 6% of the purchase price depending on your down payment and loan type. On a $400,000 home, 3% is $12,000, more than enough to cover a 2-1 Buydown. But verify with your lender before you submit. FHA, VA, and conventional all have different limits. Now the part nobody talks about. A 2-1 Buydown can actually cost you money, and here's the scenario where it happens. If mortgage rates drop significantly in the next 12 to 18 months, say, down to 5.5%, you'll want to refinance. The moment you refinance, the remaining funds in that Buydown escrow account, gone. They don't transfer to your new loan. They don't get refunded to you. The seller already paid them, and the lender keeps the unused balance. So if you refinance 6 months into year one, you've used about $3,000 of the $8,200 the seller funded. The other $5,000 vanishes. You got a 6-month discount instead of a 2-year one. Compare that to discount points. If you'd bought the rate down permanently and then refinanced, you'd also lose, but at least the lower rate was baked into every payment you made. The takeaway. If you strongly believe rates will drop below 5.5% within a year, discount points or even a price reduction might serve you better. If rates stay elevated, which most forecasts suggest through at least late 2027, the Buydown is the clear winner. Let's connect the full picture because the savings don't stop at year 2. Here's the scenario where a buyer saves $47,000. Purchase price, $425,000. Loan amount, $400,000. They negotiate a 2-1 Buydown funded by the seller for $8,200. In year 1 and 2, they save $9,708 in reduced payments. They invest those monthly savings into a high-yield savings account earning 4.5%. After 2 years, that invested savings has grown to roughly $10,300. Now, rates haven't dropped enough to justify a refi. They stay in the loan. But that $10,300 continues compounding. Over 28 more years at a conservative 7% average market return, that single lump compounds to over $47,000. The Buydown didn't just save them monthly cash flow. It created seed capital that grew for 3 decades. This is the calculation no lender will ever show you, because it makes every other use of seller concessions look embarrassingly inefficient. The 2-1 Buydown is ideal for 3 specific buyer profiles. First, buyers who expect their income to increase. If you're early in your career or expecting a promotion, the graduated payment structure matches your earnings trajectory perfectly. You pay less now, more later when you can afford it. Second, buyers in markets with high days on market. If homes are sitting for 30, 60, 90 days, sellers are motivated. They'll fund a Buydown before they'll drop their price because the Buydown preserves their comparable sales value for the neighborhood. Third, buyers who plan to hold the property for at least 3 years. You need the full 2-year savings window to capture the value. Who should skip it? Anyone planning to sell within 2 years. Anyone who's already getting a below-market rate through a special program. And anyone whose lender doesn't support Buydown escrow accounts. Smaller credit unions sometimes don't. Before you bring this to your agent, know the 5 mistakes that sink Buydown negotiations. Mistake 1, asking for the Buydown as a separate line item instead of building it into the offer price. If you write $400,000 plus $8,000 Buydown, the seller sees $408 and panics. Write $408 as the price with the Buydown baked in. Mistake 2, not verifying your lender handles Buydowns before making the offer. Some lenders, especially online-only platforms, have zero Buydown infrastructure. Call first. Mistake 3, confusing a Buydown with an adjustable rate mortgage. They are fundamentally different products. An ARM changes your actual rate. A Buydown keeps your rate fixed but subsidizes your payments temporarily. If your agent conflates these, find a new agent. Mistake 4, requesting a 3-2-1 in a hot market. It's too much money. Stick with the 2-1 when competition is high. And mistake 5, forgetting to factor in the escrow requirements. Some states require specific disclosures for Buydown escrow accounts. Your real estate attorney should review this before closing. Here's where it gets really interesting. In most states, a 2-1 Buydown can be combined with first-time homebuyer assistance programs. That means you could stack a state-funded down payment grant with a seller-funded Buydown, dramatically reducing both your upfront costs and your monthly payment simultaneously. For example, Texas offers up to 5% in down payment assistance through the TDHCA My First Texas Home program. Combine that with a seller-funded 2-1 Buydown, and a buyer putting zero of their own money toward the down payment could have a year-one effective rate under 5%. California's CalHFA program, Maryland's MMP, Florida's Hometown Heroes, these all allow seller concessions alongside their assistance. The key is coordination. Your loan officer needs to structure the concession limits so the Buydown doesn't eat into the maximum allowed seller contribution under your program's guidelines. Ask your lender this specific question: can I use seller concessions for a Buydown in addition to my down payment assistance program? If they say they don't know, call the next lender on your list. That is the complete 2-1 Buydown playbook. You now know more about this strategy than 90% of real estate agents and probably half the loan officers you'll talk to. If you're buying a home in the next 12 months, screenshot that offer letter language and send it to your agent this week. If this breakdown saved you from leaving thousands on the table, subscribe, because every video on this channel is built to put real money back in your pocket. Drop a comment if you've used a Buydown or if your lender tried to talk you out of one. I read every single one. Your next move starts now.